Hi, this is Ron Welch with Wealth Strategy Planning, and welcome to our fourth quarter investment update. We did the economic update just a couple days ago, and so now we're going to take those economic concepts and put them into investment implications and kind of walk through some of that today. So let's go ahead and start off with the chart that we typically do use, and that is known as the quilt chart. And just to refresh everybody, each year goes across the top. Each color has its own individual type of return. And the idea here is that we're just seeing how different segments of the market are behaving differently from a year-to-year basis. So the white box in the middle is a well-diversified portfolio, and that's kind of what we're focused on. So if you look all the way to the right-hand side of the chart here, you'll see that the top performing asset class is emerging markets. That's up 27% year to date, so emerging markets are doing really well. That's typically Brazil, Russia, India, and China. Obviously, Russia's not really participating in that right now. But a well-diversified portfolio should be returning about 13% year to date as of yesterday, October 14th. So with that, take a look at your statement, and if you're above that, you're happy. If you're below that, maybe that's underperforming, and you should sit and we'll talk about it a little bit. All right. So from there, I do want to expand a little bit of our bond discussion that we have with a lot of folks come into our office and they own a high percentage of bonds. And as my current clients know, that we don't really participate in a full bond portfolio. We're not really sure how you win with bonds. We're going to walk through some of that. So right now, again, on the right-hand side, we see that the 10-year Treasury is paying about 4%, meaning that if you buy a Treasury bond, so you slide $1,000 over to the U.S. government, they're going to send you 4% interest every year for the next 10 years, and at the end of 10 years, they're going to send you back $4,000 or $1,000. So with that, bonds do a great job of taking volatility out of your portfolio, so you're not going up and down and riding the wave. Obviously, the markets have been really volatile over the last week or so, and bonds help that. But I'm not really sure that they help you achieve a retirement that you're looking for. So from here, to drive home the point, we're just going to go out to Morningstar real quick, and we're going to look at this is just the Fidelity Investment Grade Bond Fund. You can go out to the internet and find this yourself. There's nothing special or secretive here. If we scroll down a little bit from here, what we're going to get to is performance. This is annual returns, so this is what it performs on a year-by-year basis. And if we scroll down a little bit more, which is what I'm really interested in, is the investment return out of this fund on an annual basis is just under 3%. So basically, you've earned 3% in bonds for the last 10 years, and so that's not really helpful. That's not getting you closer to retirement. Again, it's smoothing out your portfolio, but I'm more interested in making sure you have enough money later in retirement. And then let's not forget that inflation has been at a minimum of 3% over the last 10 years. So you've basically broken even on whatever money you have in this fund over the last 10 years. And to clarify, we see down below the percentage rank of it. This is the number 2 ranked fund. So this is an amazing fund, a great bond fund. So it's not like a fund selection problem that's causing the low returns. This is as good as it gets. So the best bond fund in the intermediate space has returned just under 3% a year. And again, I'm not sure how we get you your money to last through retirement with that strategy. So the discussion that we just had with the intermediate bonds, we're talking about bonds in that 10-year period. But next up, I want to look at the yield curve. And the yield curve is really one that's fascinating for bond people that follow the bond market. The yield curve is basically what they wake up to every morning to go see what it looks like. And we can see that there's 3 different yield curves on here depending on the time frame that we want to look at. So kind of this October 14th, 2025, and now you see the 10-year Treasury paying 4%, so that's what we just looked at. But the comments that I want to make out of this is if you go to the left-hand side of this chart, and you can see like in 2023, whether it's October or July, short-term treasuries, up to 2 years out, we're paying over 5%. And so that was a great opportunity for us to take, money instead of that sitting in your checking account or you're in a low-paying money market. We're able to go invest that into maybe a 1-year treasury and go clip the coupon, if you will, at over 5%. And that was fantastic. That was really helpful. But if we look in today's environment, now the 1-year treasury, or the 3-month treasury, to be more exact, is paying 4, and the 1-year treasury is down to 3.6. So we've kind of lost that tool of using short-term treasury bonds to handle our cash reserve spot. So we're just going to have to go to different techniques and different skills or different type of investment environment in order to accomplish that. How that shows out in your individual portfolio, let's talk about that on a one-by-one basis. But this is a way that we're definitely modifying our investment strategy due to what the bonds are paying on a short-term basis. So the other thing that I really want to get into today is just, and we've talked about it before, but now it's getting really, really pronounced. And this is the concept of the Magnificent Seven, which is the largest 7 companies that are in the S&P 500. And I'm starting to hear a phrase, the S&P 7, and then the S&P 493, which I think is kind of funny, but it is really driving home. And on the left-hand side of this, you can see that 7 stocks are absolutely accommodating for just about all the growth in the stock market. So if you were to invest in 493 stocks of the S&P 500, your return would be significantly different than if you just invested into these 7 stock funds. Okay. One of the beauties of the value of the S&P 500 is to be well diversified over 500 different companies. And now we're just seeing this incredible concentration of the wealth in this country into these 7 stocks. And so diversification is really not, if you wanted to have a positive performance returns over the last couple of years, you needed to concentrate your portfolio, which the S&P is done, into basically 7 stocks. And if any of those falter, you're going to feel it. So it's certainly something that's on our mind. On the right-hand side here, if you look at earnings growth year over year, and let's just go to fiscal year 2025. So some of that is actual and some of that is estimated, obviously. These 7 stocks, their year over year earnings growth has gone up 20%, while the other 493 stocks, earnings growth has gone up 7%. And that is a staggering number. That basically our economy is being driven by, largely 7 stocks. If you're invested those, you're pretty happy, and if you're not, you're kind of getting left behind. And then you see, a little bit below the bottom 7 the lower right-hand corner here is the Magnificent 7 performance dispersion, and you're just seeing, just incredible difference between with them and without them. It's an important piece. But really what that's doing is what happens if these 7 start faltering, and that's what I want to talk about a little bit. So here is, I really do like this chart. It's fairly simple to understand, but I think it drives it home. So if you start at taking basically the 10 largest companies in the S&P 500, starting on the left-hand side in 1985. The top 10 companies in 1985 were DuPont, Kodak, Royal Dutch, Amco, Shell, AT&T, General Motors, GE, Exxon, and IBM. Okay, and so 1985 for those of us who graduated high school in '86, that didn't feel like that long ago, but just to look at the differences that have taken place. But then you move on to 95, and the point that I want to make here is that most of the companies that were the largest in '85 are still the largest in 1995. Now P&G shows up, Merck, Walmart, Altria, and Coca-Cola come in, and then in 2005, several of the companies get swapped out. But really, you're down to AIG, Johnson & Johnson, B of A, Pfizer. So these are all from all different industries. They make money in different ways. We see the appearance of Microsoft for the first time in 2005. But now let's just skip forward to 2025, okay? And I kind of glossed over it a little bit. But in 1985, the top 10 companies represented 20% of the S&P 500. Now when we look at 2025, all these companies are kind of new brands. Not JP Morgan, not Berkshire Hathaway, but Broadcom, Tesla, Meta, Alphabet, Amazon, Nvidia. All those are brand new to this top 10 list. So tremendous amount of turnover that's taken place. But the other aspect of it is that these top 10 companies now represent close to 40% of the entire S&P 500. Okay, and so the concentration that's taking place in these companies is really pretty interesting. And so we really need, for the stock market to succeed, we're going to need these companies to hold steady, and that's where the growth is going to come from moving forward. So one slide that I want to go into first is, let's talk about the artificial intelligence, because that's really what we're talking about here. And I want to separate, when we talk about artificial intelligence, the tools. I ask clients when they come in how they're using it, how it's impacting their lives. We're using it in here. It's infiltrating every aspect and corner of our lives. And if we look at the left-hand side of this, and if you look at, this is the CapEx, so these are the capital investments that they're using the term hyperscalers here, but basically the companies that are trying to lead the way for AI. So Alphabet, Amazon, Meta, Microsoft, Oracle. The amount of their operating cash flow, they're basically taking all of their operating cash flow and shoving it into AI, R&D, and AR infrastructure. To where, if you just go back to, let's say in 2022, they were putting 25% of their operating cash flow back into capital expenditures. And now, in the next couple of years, they're shoving all of it in there. So these companies are basically betting their entire company future. That might be a little bit extreme, but they are betting their future on the ability of being a leader in the AI space. And if they're wrong, it's going to be really expensive. And the thing that we're trying to figure out is that we know that AI is valuable. We know it's going to change the economy. It's going to change how we live. But we're not sure, and this is the key piece, we're not sure how they're going to monetize that. How are these companies going to generate income and revenue moving forward? The illustration that I like to use, if you think back in the late 1990s, early 2000s, there was a company called AOL, America Online. And we were all running around trying to find the CDs that had minutes on it. And AOL was paying, their revenue was driven by minutes that we spent online. And so we would put the CD in, we'd get free minutes, and if we used the free minutes, then we'd start paying on a per minute basis. Well, AOL is now distant in our rearview mirror, and that's not the way that we ended up monetizing the internet. Okay, it ended up being a subscription basis in a lot of ways, and certainly became through ad revenue. Google makes a tremendous, or Alphabet makes a tremendous amount of their revenue through the banner ads that appear on the internet on the side, and this and that. Okay, so for those that are using OpenAI, there's a free version of it that is ad free. So we're not seeing revenue generated out of that, but they're going to have to change that with the amount of money that they're spending on R&D. Which leads us to the next thing that I really want to talk about, is that OpenAI and AMD came to an agreement that was really interesting, and it's been done before, but the scale that they're doing it is pretty amazing. And since this original deal, they've gone out and signed similar deals with other chip companies. And so OpenAI basically made a commitment to AMD to use their chips to build out the infrastructure that they need. In exchange for that, they now own 10% of AMD. Okay, and you're going to start seeing this word, if you haven't seen it already, as this being like a circular agreement. Okay, so it's not like OpenAI, the chips that they're buying over the next, 1 to 5 to, in chips in the future, they're not necessarily struggling to check for that. They went and exchanged those chips for some ownership in the company, and now they're going to, in a sense, rent those semiconductors over time, which kind of just changes the whole dynamic of this. Okay, and so we're a little bit uncomfortable with this type of arrangement. The companies are arguing it's not circular. It sure sounds circular to me. And what is this? What is the large impact of that? So we've created a situation where we know that we need to be investing in technology for us to grow your portfolio, but we're also getting a little bit leery on how these investment, or how these AI companies are going to monetize and the revenue, and how they're structurally setting up these deals to provide the computing power that they're going to need to run. So in one sense, we're all in and we have to get in technology, but we also have a little bit of weight on our back foot, just making sure that we're okay here. And sort of the analogy that I used this morning with a client was, we know we need to stand next to the fire in order to stay warm. We're just worried that we don't want to stand too close to it and get burnt. So the things that I'm focusing on a day-to-day basis is just making sure that the transition to AI economy is safe. And if the repeat of 2001, 2, and 3, also known as the dot-com bomb, if that repeats, that we try and get our portfolios in a little bit more protected position to make sure that you avoid that big downswing. So those are the comments that I have for this investment update. If you have any questions or anything that you want to talk about, just give a call and let's walk through it. So have a great day, and we'll talk to you soon. Thank you. Bye-bye.